I've got a guest here today, and I'm excited to bring him on. Darryl Lyons, you're an author, and obviously you're a financial planner. You deal in the world of money. You've been in the world of money for a long time. Let me ask you a question. How'd you get started into this business to begin with?
Yeah, we were talking about that beforehand. Michael Lewis's book, Liar's Poker, that was an inspiration. He designed it to tell people about the corruption in the industry, and it inspired a generation to jump in the industry. That was a part of it. I grew up without money. We lived in a little single wide trailer in Castroville, Texas, and we just struggled with money financially, and I just wanted to figure out how it worked. My mom had me when she was 16. My dad was 20, and they just struggled. And so how does this money thing work? So when I was in college, it was in the late 90s, and that's when the dot-com bubble was going on. And so I was doing some trading then, and actually I got a degree in accounting and finance and started the day after I graduated. And I was working my way up to a New York or Chicago job, but I didn't. Those cities are great cities, but San Antonio is home for me. So about 12 years ago, I started a business in San Antonio so I could raise my roots here.
I've been to San Antonio a few times. I've been to Dallas much more, in Houston, but we have a lot of people from Texas. Where'd you go to college?
St. Mary's University in San Antonio, born in Dallas, and then been around most of South Texas most of my life.
Yeah, my brother, I wish he was here right now doing the interview. I think Texas should have been his home state. I kind of want to ship him there half the time as well, get him out of my hair a little bit. But Texas is a wonderful place for entrepreneurship. I grew up in Utah, and I got to say, a lot of the mindset about small town, hard work, pull yourself up by your bootstraps, go out and get it done. It's what I grew up with, but also that same kind of spirit and attitude in Texas, right?
Yeah, no, it really is. I think it's just a culture of optimism. And, our currency here is trust. I'd say maybe New York, the currency there is knowledge, but here it's trust. And so, people, when trust is violated, then, business dies. So people generally, of course, not everyone's perfect, really want to make sure we do the right thing because business moves at the speed of trust. And so that's just a cultural thing, and it's taken place for years and years and years now, and it's developed into something pretty special.
I see. Now, the book, what's the title and what's it all about? Give us a quick rundown of what that book is and why somebody would want to pick it up.
Yeah, so the book's 18 to 80, everything you should be doing with your money from age 18 to 80. And I only go into ETFs in one chapter, but the book is just a really practical guide. Underneath the book is an area of study called behavioral finance, which is a collision of psychology, neuroscience, and traditional finance. But I wanted to lay it out in a very layman's terms, so that way my mom and dad could pick up the book and go to their age and say, what should I be doing at my age, and what should my kids be doing at their age? It's just a really easy way, because a lot of people don't even read anymore. And so how can I create something that with people?
It's crazy. I mean, people are not spending time on self-development and study and all those kind of things. And I understand it's intimidating. And we live in the world of YouTube where you can Google anything, look it up, YouTube it up. But there's something different about reading. And I'm a physical book copy kind of guy. For me, it's the way I learn. I know my wife is, she's all about the Kindle, but I saw the book and I got to order a copy. I've not picked it up yet. I just barely looked into it. But where's the best place to find it, first off, before we get deep into the content?
Yeah, I would just jump onto Amazon. It's easy. I used to have a link on my website, but it just created one level of friction for people to go and get it. So I just sent them to Amazon, grab the book, leave a review if you like it. But it's pretty easy to digest. And I'm in your camp too. I'm still a paper book. I write notes in my books. I put it on the shelves. I stare at them. That's just how I am.
Yeah. We're talking to Darryl Lyons here, the author of Money and Retirement for All Ages, 18 to 80. And I want to get into that. In my opinion, there's 4 cornerstones to personal finance, including investing. One is, living within your means. As I travel and talk to people all over the country and literally all over the world as well, I sit down and have discussions about their personal finance. And frankly, and I understand the cost of living is excessive, especially in cities like New York City and Seattle and San Francisco. But people spend what they make, Darryl. I mean, have you seen this as well, that people just kind of spend what they earn?
Yeah, and I think to your point, they do. Those that know me know that I'm a huge Dave Ramsey fan. I've been working closely with him, and he always says, act your wage.
Mm-hmm.
And so I like to adopt phrases. I'm not really good at creating my own. I just steal from others. But
Yeah.
the idea of living within your means is certainly a reality, and not being able to do it, but also taking inventory of the people that you're around. We're the average of the 5 people we spend the most time with. So it tends to, our income and our spending, even our spending tends to drift in the direction of our peer groups. And so you may find yourself spending more money, but if you look at the neighborhood, well, there's a reason you're spending all that money. You're trying to keep up, and it's just so subconscious, isn't it?
Yeah, it's amazing, and I'm not opposed to spending. I mean, don't get me wrong. I believe my dad was very thrifty. If I lost a wrench on the tool, or a tool on the job site, I grew up a contractor's son. He would take it out of my paycheck, right? At 13, 14 years old. So I get it. He's thrifty. I'm not that, but more frugal even would be a good word. But here's the thing. I mean, don't buy stuff you don't need until you have the extra cash flow to do it. It's one thing to spend, and it's one thing to have to spend in this world, as you move yourself forward. But man, I see consumerism just rampant. People buying a $40,000 car before they need it. There's a lesson from Warren Buffett, in my opinion, that he still lives in the same house that he did in 1963 or whatever it was when he first moved in. You can build wealth, you can do a lot of things and still live within your means and have a good lifestyle. The second one for me is learning how to save. And I like that you bring up Dave Ramsey. In the field that I'm in, a lot of entrepreneurs and investors, they attack savings. And I don't understand it. Have you seen this, by the way, where speakers or other people, they're like, oh, don't be a saver. Don't be a saver. You got to go out and invest everything.
Yeah.
What's your take on savings?
Well, I believe the best portfolio is an undiversified portfolio when you're right. And so the idea is that you're betting on yourself because you believe you're right. So investing in yourself makes a ton of sense. But the reality is that it will not hurt you to accomplish your goals by setting aside 10 or 15% of your income in a very passive approach to diversify your life. If you think about it, somebody who might have started a hardware store and they wake up 30 years later and most of their net worth's in their hardware store, and they're the best business person, they've done everything right culturally, checked all the boxes. But if Walmart moves in next door, they're toast.
Yeah.
And so the idea of if that person had saved 10 to 15% of their income over the years, they would still be okay. And so I think for anyone that's starting a business, they're going to be better off. Their rate of return is going to be much better off if they bet on themselves and they win than they would in a passive portfolio or strategy. But still, it's just a prudent decision to save 10 or 15% of your money and live life.
Well, I guess my only rant on this one for me personally is that people who attack savings are usually doing that to pursue their own ends, right? And I'm not a believer in savings past a current level or a certain level, which is where number 3 and 4 come in. I mean, I don't think you should only save money. If you never invest money, you're going to fail at some point. And if you never take chances, you're going to fail. So savings as a replacement for everything else, in my opinion, is a mistake. But you got to save enough to cover some crazy expense. I saw some number the other day, Darryl. Less than like 50% of people could pay for a $1,000 expense if it hit their desk today.
Yeah.
You have to go into credit or something like that. I can't remember exactly where I found that stat, but there's a lot of people that are struggling, and I get that. Saving a little bit extra, paycheck to paycheck, will help you to get to the point where you can do number 3, which is use debt properly. Instead of using debt for consumerism and all that kind of stuff, maybe we can learn to use debt to leverage investments or start a business. I was having a conversation the other day. You're a small town kid. You pull yourself up by your bootstraps. You come from, humble beginnings, and here you are. You're an author. There's not a lot of people in the younger generation that has that spirit. I don't know about you. I've got an 18-year-old daughter. I teach millennials all the way from 18 to 65 as well. Has this generation, are we just going to be a couple old guys here and complain maybe, but has this generation lost some of that entrepreneurship?
Well, we know that constraints breed innovation, and that's in business, but it's also in life. And so the reality is I was just in this constrained environment, and I had to figure myself out how to navigate that. And so there are environments where those constraints still exist. I was talking with a young man just the other day, and he comes from basically the ghetto, and I see him just thinking creatively about how to pull himself out and change his family tree. That guy's going to be a future leader. But unless we have some constraints, it's difficult to think that way. And so what's happening is because we have such a good economy and a good lifestyle, that there's not these constraints on many in this generation. So it doesn't require them to think that creatively.
Yeah, I think that's right. I mean, they don't have to innovate. And they kind of are. I think what you just said is they're entitled. You just said it in a much more academic and very nice way. But maybe all of this nice being able to log on to Instagram and have food delivered to your house, maybe they don't have to actually learn that hard work stuff, right?
Yeah, I mean, hey, some of them are making 250,000 a month on streaming Fortnite, so they're out there.
Criminy. Which is why, as an investor, I'm very fascinated with Electronic Arts right now, because they just launched that new free game and everybody just like went to it.
Yeah.
Their profitability surged, whatnot. I trade the markets each and every day. That's what we do at Trading Justice, talk about trading the markets, which we'll get to. And that's number 4. And to review here, my 4 cornerstones of personal finance, quite frankly, are live within your means, save until you have a little bit of a cushion, then use debt properly, not 27% APR for consumer products, but go and start a business, fund your education, whatever it is, but then learn to invest, which is what I think your book is really about, is learning to invest at all ages. Let's go through it kind of group by group. What do you tell young people?
Yeah, I like for them to develop a pause in their purchasing. I mean, what happens today is we've got this one-click pay and optical purchasing, and it's it's like what, you just buy, and we know retailers get it. Some retailers will even put the smell of apple pies in stores because they know the probability of you buying goes up X percentage. So,
oh my,
it's freaky. These marketers are brilliant, and then come Christmas time, and we're toast as consumers. We're just not prepared, and so. If millennials, or even in millennials, we're actually talking about the next generation now, but if the younger generation develops a pause in their purchasing, just saying, you know what, I'm not going to buy this right now, I'm going to think about it, that alone will put some extra money in their pocket, just that alone.
Mm-hmm. Yeah. So then that next phase of life really is about once you get out of college, maybe settle down. If you get married, I got married, had kids, that traditional cars in the garage, you got your first house. What do you tell that person that's in that late 20s to mid 30s, late 30s kind of range?
Yeah, so this is when you have to what they say, adulting, right?
Mm-hmm. Right.
And so what I did was, when I first started my career in financial services, and I was a hot shot, and I was my BMW convertible, and I was moving up to Wall Street. I got my first house, and I said, I just want to be an adult. So I sold everything that I could and just reset. I didn't care what my peers said. I went down to one used car for our entire family. We used cash for everything. We were very, very conservative, got ourselves out of credit card debt, got myself out of student loan debt, just very focused and very mature, because that season of constraint and just toning it down was just very healthy for us today. And as a result today, things are much easier, but we had to make those sacrifices at that time. And so I think it is just a time to say, look, I just need to be an adult and be mature about my decisions. And if I've made mistakes, I got to get out of those. And there's going to be some pain involved with that. But long run, it's the right thing to do.
Yeah, for sure. I mean, you got to do things you don't always want to do. I still have friends that don't like talking about money. It is what it is. I'm almost 40 years old now. I graduated from college 15 years ago, and they still don't like talking about money, but that's probably why they might be still broke. And still my buddies who ask me for some of that at times. I get it. It's not always a fun conversation to have. And if you feel like you're out there pushing and hustling and struggling, you don't always want to be an adult, which is why Fortnite, by the way, still is so popular in those games we were talking about. There might be a correlation here between the I'm not so sure. After you get into that next phase, and what I've learned, and I have a belief that men and women who are really career ambitious and really want to push, they have their best earnings potential in this next phase of life, in their late 30s, 40s, even early 50s, maybe beyond all that. And I know that might be a stereotype. What advice do you give somebody who's got a little bit of something, maybe some equity in the house, a couple $100,000 in 401k? How do you approach that person?
Yeah, you do have an acceleration there of your income, and the temptation there is to adjust the lifestyle to that income.
Mm-hmm.
And it happens all the time. So what's happening now with the prices of homes is that we're seeing people say, well, I can afford that payment. And so as a result of being able to afford that payment, maybe it may be 30% of their take-home pay. But as soon as their take-home pay changes because the market environment changes, it's going to put a lot of stress on their family. And so making sure you, as to your point, live within your means, but be very careful that you don't have this lifestyle creep. And you find yourself, if you do start to creep your lifestyle, make sure that there's ways that you can get out of it quickly. And so, adding more debt to your family budget is the ticking time bomb. So be very careful there.
I have 5 brothers and a sister. Grew up in a household of 7, Mormon household out here in Utah. And you just made me think of my little brother. And I hope he watches this. I'm going to send this interview to him because I understand you can go too far one way, maybe purchase too quickly or too big before you're ready. But that kid has been saving his money for like 10 years and he's never bought his first home. I think he's going to do it this year. I talked to him. We were at a 49er game this year. It's one thing to be cautious, but you can be a little bit overly cautious at times, right? I mean, you got to buy your first house at some point.
Eventually you do.
Yeah. I think so. Davey, if you're hearing me right now, that means you might need to pull the trigger on that at some point. That's right. I get it. And you can go beyond your means. And by the way, one of the markets that a lot of new homeowners may not have experienced are variable interest rate changes. We've had such low interest rates for so long. Yeah, you could have economic changes. You could have employment changes, but what if the Fed actually raises interest rates here, Darryl? I mean, that might affect those variable loans that people have tied into for 10 years or so.
Yeah, those are dangerous. I mean, I just don't want to add risk to life. And we really have to put it in perspective. We're the richest nation in the history of the world. So how much do you need? I think me living without a lot of money, growing up without a lot of money, I'm pretty good. I don't have to prove anything to anybody. I don't have to have the nicest house or nicest car. Neither do you. We don't have to prove it all the time. It's okay to just have reasonable stuff. We're still the richest nation in the history of the world. So I think you do have to take inventory of your point of reference. And that's why I often tell people the idea of giving to ministries and charitable organizations and being engaged with those organizations keeps life in perspective and keeps you from having to always perform and always buy the latest stuff.
Mm-hmm. As I think about giving people direction, giving people advice, I'm not a financial advisor. I'm not licensed. I don't ever tell people what they have to do or what they should do. How do you walk the line in being direct or coaching somebody to think for themselves, at any of these different ages?
Yeah, certainly. I mean, I've been doing this since '99, and I've spoken kneecap to kneecap with literally thousands of people one-on-one without their money, and it's still something I work on. Mm-hmm. I wish I'd had secret sauce, but I'm always challenged every individual on, is this a time for me to be very direct, or should I be consultative or Socratic questioning, asking them questions for them to develop the answers? It is not easy. And that's part of the reason over the last several years, we've tried to understand what behavioral finance really means and how we can help people. There's a statistic that has recently come about that says that people's wealth is a result of 13% of people's wealth is as a result of asset allocation, stock selection, and market timing. The other 87% of somebody's wealth is a result of their decision making. And so really where we've been spending time in our office and all of the advisors here is trying to ask ourselves, how can we help people to make better decisions? And so one of the things that we did is we hooked up with a company called United Capital, and they helped us integrate some of the behavioral finance experience so we can be better positioned as somebody's money guide to help them make better decisions. And that does require us sometimes to be direct, but it's more of an art than a science.
Yeah. And I really think when it comes to reward and risk, I mean, different phases of life historically have pushed people into different asset classes because of safety or whatever it might be. Going to that next group of people, the retirees, the traditional retirees, which is my dad and my mom. My dad turned 70 this week, so it kind of fits into his timeline and whatnot. I mean, they're supposed to be a little bit more risk averse, but yet many of them are still tied into the stock market because interest bearing payments like bonds and savings are no longer very attractive. And so, even at older ages, it seems like we're forcing through our economy to push people into risk. I mean, what advice do you give them, and how do you help them understand market risk when we've been in a 10-year run?
Yeah, it is tricky. To your point, the interest rates, the coupons haven't really been paying a whole lot. Now, last year, the Fed raised rates a little bit, so we're seeing a little bit more yield on that fixed income part of a retiree's portfolio. But you're right, there are a lot of equity-driven portfolios, and the market, the financial marketplace has tried to create some products that can fill the gaps in that space. There's some business development corporations, the annuity marketplaces, and then some of the hedging strategies. So there are a handful of what we would consider alternatives to the fixed income space that's allowing a retiree to diversify. But that does require a new level of understanding of what's available and the risk reward profile of those as well. But there is some adaptation because it's been going on for a long time, and the marketplace needs some alternatives to these low interest bearing bonds.
I think so, and I know it's more advanced, and I know it's intimidating. It's not for everybody, but in my opinion, this is why the put market and the options market and derivatives do exist for active traders who are educated and know how to use them, right?
Yeah.
You can stay in equities and still protect yourself if you know about those types of products. I know you probably deal with a lot of people across different ambitions and what they want. What's your view on the derivative market right now? Because we use them all the time. I mean, in our podcast, our listeners, they know about put options to protect.
Yeah. So the options markets are, obviously the reason that they have a bad rap is because they've been used as a speculative tool. And in some cases, people are able to make money, but traditionally they're used as a hedging tool to protect against downside risk on an alternative bet, for lack of a better word. Mm-hmm. The sophistication is there, and it requires somebody to have the time, the tools, which are all available now online, the expertise, and finally, this is the most important, the emotional fortitude to be able to do it well. And so those people that you work with are obviously equipped to do it. And then those that can't, there's firms out there that do it for them. And then obviously there's a fee for that service.
Well, and here's the thing. You had a track, you were going to Wall Street. You ended up becoming more, running your own firm, staying there in Texas and doing all that. If you were on Wall Street, you would probably be working in hedge funds, right? And managing money and talking about that internally with your own investors. But that's not something the public hears about. The public doesn't really hear about hardly any of this stuff. What's your view of Wall Street? I know that's a loaded question. That's like a huge, let's open the floodgates here. What's your view of the industry right now?
Well, so it's changed, which is good. What was a concentrated group of people in New York has now expanded across the country. And so it's just not New York anymore. There's financial hubs in Chicago, Dallas, Kansas City, San Francisco, San Diego. And so now we have this different culture with different purposes. So it's taking some of that power away from a concentrated group of people. The other thing that's happening is because of some of the fiduciary release recently, we're seeing a deceleration in the fee structures. So these asset managers, because of the transparency, are being paid less. Many of them are getting laid off. And so we're seeing kind of a kind of a reorganization. It's not a decline in the economic engine. It's just a little bit more of the power is going to the consumer now. They're seeing the fees. They're seeing what they're paying for. They're demanding excellence. And I think that's helping all across. I think it's still going to take a few years. You still have, if we can get the regulatory environment right on Wall Street, I think you're going to be able to see a lot more progress. There's about 4 or 5 different regulatory agencies, and that's just too many.
Yeah. Well, part of the problem there, I think, is that there's such a big lobby. They might have some pushback on getting more regulation, right? I mean, there's a political angle here as well.
Very
Uh,
much.
Wall Street always, by the way, if you look at any presidential election, they give money to the Democrat and the Republican because they want to line both pockets. They don't want to have to pick the winner. They literally just fund both of them because they want to keep policy in their favor. And it brings up another point here. I mean, those fees you're talking about, and consumers are getting smarter, by the way.
Yeah.
The number one investment for a millennial, I saw an amazing stat recently, is an ETF.
Yeah.
They're more likely to invest in ETFs than other generations. And I think that it used to be mutual funds were a very popular product. Now people are getting smart and wise to it. And index funds, maybe it's Warren Buffett's message and, that random walk down Wall Street stuff. And I know he just passed away, John Bogle. I mean, those types have really educated a generation of investors to move to the ETF product. What's your view on mutual fund fees? Why are they so high? And how can we get more people to embrace getting education and understanding ETFs and lower fee products?
Yeah, so mutual funds have traditionally been high because they haven't had to have transparency, right? Why, like, if there's no transparency, why mess with it?
Yeah.
So we've seen them come down considerably. It's still trending downward, and I think it'll still go. I think it'll settle somewhere, maybe at 25 or 30 basis points. It'll never get to the ETF range, but and then there'll be some consolidation in the space. But you're still going to see some funds out there. You're probably going to see the better ones stick around. Think about like somebody like American Funds, Growth Fund of America, that's been around since the 70s, and they might charge 30, 40, even 70 basis points to some of their funds. But their net rate of return has been considerably out more than the index. Those types of funds will stay, right? And so the ones that can perform net of fees will stick around. But the ones that have had to use their sales force to keep them alive, those ones will be consolidated or die.
And I worry about those kind of companies, and I don't want to name companies, but I'll just say Ameriprise, New York Life. And I'm sorry, there's nothing wrong with it. I actually have friends who work in those companies, and I've had students over the years come and say, "Hey, Tim, what do you think if I went and got a job selling mutual funds?" I'm like, I get it. I get it. There's a reason why you make high commissions, though. Usually you're paying a higher premium with fees built into the fund if you're getting that door-to-door commission sales guy, don't you think?
Yeah, they're definitely there. I mean, I had to start out at those firms, and it's just it eats you up after a while seeing that there's alternatives out there, and it just kind of just irks at your stomach. Some of those, there's good people there, definitely, and most of them are good people trying to do the right thing. I don't know if they just can't add because it just doesn't make sense. But some of them get locked in. Some of the good ones also get locked in through deferred compensation plans, and it's just foolish for them to even try to look for something else.
Oh, I get it. I know a guy I grew up with that makes a very good income, and he helps people, and he's doing the best to educate people on investing. And I get it. I mean, by the way, I have no problem with somebody making a premium for their services if they're providing premium in that service, right? Or like you mentioned, the fund. What was the name of the fund that was outperforming?
The Growth Fund of America, American Funds. Yeah.
Listen, if they make more money than the market and they justify the cost, why not? I get that part of it. So there are times where you can justify a little bit higher fee, but I'm not a real big believer in mutual funds until they become competitive with ETFs. That's my take personally.
Yeah. And I always have to provide full disclosures to your listeners. I don't wholeheartedly endorse that fund. I just use it as an example for.
Very good. And I'll make sure that we're clear on that in the write-up as well. We're not giving advice. We're just talking generally about the market, right, Darryl?
Yeah.
That's right. All right. We could talk about anything, but really there's two things I want to ask you about. Daniel Kahneman was a name that you mentioned when we were doing prep here before we started, and it instantly grabbed my attention because I recently, and I did not know much about him until I read this book, The Undoing Project. I was telling you about it.
Yeah.
Michael Lewis is one of my favorite authors. And the first book I ever read by him was Liar's Poker. Ago. And you mentioned that as well. Who is Daniel Kahneman, and how does behavioral economics impact the way that you think and your curiosity?
Yeah. So I tell you what, this is the next generation of the financial industry. It absolutely is. I would place a bet on it. Daniel Kahneman's work in the 70s. He's a Nobel Prize winner. And he recognized that there's two parts of our brain. There's the fast brain and the slow brain. And so that's the title of his famous book, Thinking Fast and Slow. And the fast brain typically is the biases or the things that almost like knee-jerk reactions that we have to making purchasing decisions. And it's rooted in how our parents did or didn't teach us about money. And it's the way we make decisions without even thinking about it. It's subconscious. The slow brain is more of a rational part of our brain, aligned with our goals and our values. And so what we have to do is whenever we're making decisions, we have to identify and maybe reframe. Are we using our fast knee-jerk reaction and our biases? Are we thinking rationally about this? And so he talks deeply about that. And really, I think the industry, the financial services industry, is recognizing the value of that as well.
Wow. Dude, it's awesome. I could talk to you all day. There's no doubt. But I have parent-teacher conference for my 9-year-old today.
I get it.
I got to go check in and make sure that kid's doing her work. My kids go to a Montessori school, and I love it. My oldest goes to a public school, which is a great school. She's graduating high school this year, and actually she'll be moving to Texas.
Cool.
She's joined the Army, and one of the bases down there she's going to go and do her basic training at and become a medic and whatnot. She wants to become a doctor. And
Army
I think so, yeah, through medical and whatnot. And then my younger kids, they're in Montessori school. They're quite young, but it's an amazing blessing to be a father. And, people talk about money and all that kind of stuff. I love money for a lot of reasons, but not just to stack a bunch of it for ego. It's because it lets me work from home and it lets me open doors. Personal finance is important. And I think if people can figure that part of it out, so much of their stress is in their life, and just realize there's a big picture here. Getting yourself to retirement, focusing on the things that really matter. Darryl, any last bits of advice for our audience here?
No, I'm glad I could be here. I want to keep encouraging your listeners to invest in themselves, make wise, prudent decisions. It's a long journey, this money journey. Getting rich overnight is not the goal. I think that you would agree. It's a process. And so just take your time, be patient. And the experiences that we learn on the mistakes we make are just as valuable as the upside.
Yeah. And I always say people, they overestimate what they can do short term. They think they can go out and start a business, get rich right away. They haven't thought about all the problems, right? Or they can go out and go into the market and trade the market and all of a sudden make all this money, which isn't in the cards, but they underestimate what they can do in the long term, proper investing and getting proper rates of return and getting control and avoiding losing all your money if the market crashes. Little things that will help smooth your equity curve. And just the principles we've been talking about here today. I'm going to pick up a copy of your book. I'm going on to Amazon right now. Give me the full title one last time, if you will.
Yeah, it's 18 to 80. So it's everything you need to know about your money from age 18 to age 80.
Awesome. Darryl, thank you for being here. Appreciate you, sir.
Thanks for having me. I'll talk to you soon.